Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome my good friend, Dennis Kubaile. Thank you, Dennis, for joining me on our Fortuna Advisors podcast, Create More Value.
Thanks for having me, Greg.
Dennis is the co-founder of Granulytix, a business analytics company that started by offering clients granular visibility into profit concentrations across products, customers, geographies, and channels, and is expanding into offering an agent Gen AI solution for financial and strategic analysis. I have found the work done by Dennis and his team to be very useful for companies that don't have a clear sense of where they create more or less value, which unfortunately is most companies. Prior to founding Granulytix, Dennis spent over 20 years in strategy consulting with Maricon Associates and Galton Company, delivering value-based strategies to clients like Caterpillar, Abbott, and Boeing. And of course, our last episode featured Andrew Bonfield, the CFO of Caterpillar. Tell me, Dennis, what inspired you to launch Granulytix?
Thanks, Greg. Well, take a step back. All of my projects with Galton Company and Maricon Associates always started with a very granular assessment of economic profitability. And by granular here, I mean across individual products, all the way down to SKUs, across customers, geographies, channels. And we leveraged that information to generate insights about the business, where they were making money and where they weren't. Speaking generally, what you saw was called a third or so of the portfolio was generating more than 100% of the profits. There was roughly a middle third that was called roughly break even, and then another 20 or 30%, which was actually unprofitable. Having that picture was hugely insightful to our projects and to our clients. And often after we went through it, it was not what clients were actually expecting. Sometimes they had a feeling of something would be more profitable or less profitable than another segment, but sometimes it was eye-opening. They didn't realize just how profitable or just how unprofitable a particular segment was. But once we had that picture, changing strategies to create more value, like your podcast, sort of just jumped off the page. When you know what's profitable, reallocating resources to grow those segments and figuring out how to do that. Or when something is unprofitable, what do we need to do to improve the performance there? Is it pricing? Is it cost? Is it our product offer? Or is it even the segment that we want to be in? Asking those questions. And the impact that this had on our clients was often tremendous. For a specialty chemicals business, when we first measured them, their economic profit was just $6 million on $3.5 billion of sales. After all the strategic changes that we recommended and that they took, 3 years later, that $6 million had turned into $160 million of positive economic profit. So when clients saw both the insight and the impact that came from granular profitability, we'd often hear comments, I don't know how I ever managed the business prior to having granular profit. Mm-hmm. And that then was followed by a request. Can you help me get this on an ongoing basis? And as consultants, we would do this to generate insights, to make strategic recommendations. We weren't actually knowledgeable about programming systems, et cetera. So we'd say, sorry, that's not really what we do, but we can talk to your IT teams. We'll put together a methodology document. Oftentimes these documents were 100 pages or more. And we talk them through it, hoping that they'd be able to translate that. In many cases, they weren't. And that led to clients asking us to come back to do a refresh 2-3 years later. The turning point came when my partner, Garrett, on his last project, ended up not building this profitability model in Excel, but instead building it in Python. And that gave us the recognition, you know what, we can actually codify all this, the methodologies, and connect to the various systems to pull the data to give people exactly what they wanted, ongoing reporting of granular profit. And that was the impetus, essentially, the inspiration to starting the firm.
That's great. That's great. And by the way, you speak about being able to see the granular economic profit, let's say by product or channel or what have you. It's amazing to me how people rely on like contribution margin at that level because they're worried about allocations, which I know we're going to get into in a little bit. But very often when you look at the sort of ranking of what products have the best contribution margin, it's very different from which products have the best economic profit. And by the time you allocate all the costs do not allocate equally. And some things use more capital, some things use more of some of the unallocated costs, and the picture can be vastly different. It almost always is vastly different. I mean, it's really amazing. So the work you're doing is, I think, very, very valuable. Can you give me some examples of insights that granular economic profit provided? By the way, you're going to share a slide. For those of you listening to this on the podcast, we're going to share a slide which will be visible on YouTube. But I just wanted to mention that now.
Absolutely, Greg. I mean, we could probably sit here and I could tell you stories for days. But let me break it down into two components, and I'll give you two stories here. The two components that we regularly see when it comes to measuring granular profitability. Number one is insufficient granularity, where by looking at things on an average level, they miss insights at a deeper level. And the second issue being incomplete costing. This goes to your prior point about contribution margins and intermediate level of profitability that isn't fully loaded. My favorite example on the insufficient granularity sides is probably from a regional bank. This bank, its reporting structure was organized regionally. So they had 6 regions. Each of those regions was further broken down into individual markets. And when you looked at profitability, and we'll show the slide here, there was not a lot of variation across the different regions. The variation that did exist was explained away by saying one market was more profitable because we had a longer history in that market, so we're more established, or maybe another market is more competitive. There are more competitors there, and that's why margins are lower, etc. Anyway, we ended up taking things down several levels. The first level was to break apart profitability by product. And what we found here is huge concentrations. The deposit products were very profitable on an economic profit basis, and the lending products less so. That had a number of reasons for it once you apply funds transfer pricing protocols and assign economic capital to the different products. But this was eye-opening. It was not something that they immediately recognized. And we were able to take that product mix across the different regions and use that to explain what drove differences in profitability across the different regions. We ended up going beyond just product profitability, though. Take their commercial lending portfolio. That was slightly unprofitable. So we wanted to understand what was going on there. And we broke that profitability apart into individual loan note to see what kind of concentrations might exist across different customer segments, across different sizes of loans. And we ended up discovering that a large portion of their portfolio was actually really small loans. And those loans carried a lot of cost. You had to pay system costs for entering those loans into the system and to service them, etc. And we were quite shocked by just how many of these small notes were out there. We ended up doing some more digging and discovering that small notes were easier to pass through lending committee,
Mm-hmm.
and also that the RMs ended up getting paid more on the smaller loans. So there was an incentive for them to take a larger loan, let's say financing an acquisition of 100 vehicles, instead making it 100 small loans for each individual asset, basically. And with those insights, we ended up making a lot of changes. We changed our incentive program. We also ended up changing what products they were focusing on and where they were investing in new product development to focus more on deposit products, which were more profitable, et cetera. And at the end of the day, within 1 year, they ended up driving economic profit growth within that commercial portfolio by 25%. So that was the insufficient granularity example.
Mm-hmm.
Moving on to incomplete costing, the margin case, I'm going to take a medical diagnostics business here. And they were managed, or managed themselves by country, essentially, and they measured country contribution margin. So they left out a whole bunch of costs that sat either at the regional level, and region ended up carrying a lot of marketing expense, as well as things at the corporate level, their general corporate overhead, as well as R&D. And they didn't consider the balance sheet, which had grown tremendously over the last 5 years prior to us getting involved there. So while at the country level, their contribution margin was roughly 20%, all the other costs added up to roughly 25%, such that their economic profit margin was roughly negative 5% on average. Now, getting these costs out, pushed out to the different regions helped us, and to different products, helped us understand actual pockets of profitability within their portfolio. Even though they were negative overall, they did have some pockets that were profitable. And so that helped us, again, identify opportunities for them to focus in and grow those profitable segments. They had entered a segment which we showed them was actually unprofitable, not just for them, but for all their competitors as well. So we helped to de-emphasize investment in that segment. We changed their cost structure. They had excess capacity, which we ended up getting rid of. We also ended up adjusting their pricing model in order to capture the full cost, especially of the balance sheet that they were putting into these different customers. We focus on different customer segments. And in that case, we were able to improve their economic profit on a $2.5 billion business. They were running at about 140 million negative EP for about 3 years consecutively prior to our involvement. And 3 years later, that negative 140 turned into a positive 100 million of economic profit. So that was a 250 million improvement on 2.5 billion, almost 10 margin points right there.
Amazing. That's an incredible improvement. That's really, really incredible. So what's involved in measuring granular profit? It involves allocations, of course. And I know many of clients that I've worked with over the years they're concerned about allocations, since they often wind up in endless arguments about how to allocate this cost or that capital item or what have you. I mean, how do what's involved, and how do you actually get it done without a lot of bickering?
Yeah, that's a great question. I feel like the word allocations causes a manager's hackles to get raised, to get all defensive. Let me not take these costs. Let me push them elsewhere, right? But it really comes down to, at the end of the day, intent. So when most organizations hear the word allocation, it's often just overhead that needs to get pushed somewhere. And often it's with these broad brushstrokes. One client I was involved in ended up allocating corporate overhead basically in one fell swoop to the different divisions based on EBITDA. So the argument was, well, they're more profitable, so they can handle these costs better.
Right. Like that has anything to do with what you're trying to measure,
right? Exactly. So the intent is actually what is different here. It's not for these costs to reside somewhere, but rather to understand the true economics of bringing a product to market to a customer. End to end, what does it cost you to make the product and ultimately sell it? And being much more deliberate there in thinking through, well, what are the different components that these costs are, and where do they belong, right? And a lot of what we do isn't necessarily the overhead piece, but it is within a business unit or within a segment, getting the costs assigned to individual products or to different customers. And we just need to look at the different cost components and trace things back, right? So you have marketing campaigns. You say, well, what were those marketing campaigns? Some of them were product specific. So, okay, we'll identify what that was and push that cost to the specific product, et cetera. And again, it's once the client sees the insights that they start to change their attitude towards allocations and recognize what it means. So you were talking about contribution margins. So abstract away here for a second. Though all the other costs there's variability in those costs in terms of what a segment consumes, or a particular product consumes versus another product, right? And the problem
Mhm.
is oftentimes managers just apply rules of thumb. So let's say all your overhead costs come to maybe 15% margin points, right? The
Mhm.
problem is typically that can vary quite significantly. It can be almost twice as high in one segment and
Mhm.
maybe half as high in another segment, right? So you take a segment that is making 25% margins, you think 15% cost, so 10% at the end of the day, I'm good. But let's say that segment actually takes up twice as much in overhead. At that point, that 25% margin with 30% cost becomes unprofitable.
Mhm. Mhm.
Meanwhile, you have a different segment which is actually less profitable on a contribution margin basis. Let's say it's only 15%, and you say
Mhm.
15% overhead costs would make that segment break even. But maybe that segment actually only consumes half of the overhead. At
Mhm.
that point, that 15% margin becomes 8%, or something like that, which then becomes very
Mhm.
different signals versus what you had before. 25
Mhm.
versus 15, you're now -5 versus 8. So
Yeah.
where you decide to invest becomes completely different, right?
Yeah, I think that's really interesting. I just want to add a little bit to this based on my experience because I think this is a really important area. We had one large company we worked with, a Fortune 100 company, some years ago, and we went through a very deep process of allocating costs and capital. Not quite as deep as you go, but relatively deep. And we got into one meeting where there were all sorts of arguments, as you often have, about you're just making me look bad and so forth. And so we just instead of arguing, we asked them, how would you do it? And there were several cost categories they would do differently. And so they spelled it out in a lot of detail. And we went ahead and tested what if we listened to them and just ignored what we came up with. Not that we thought they were right, but we just wanted to see what would happen. And over 98% of the uh, products that we were measuring would have the same sort of message. We should grow them, we should fix them with their allocations as with our allocations. There were just a couple of small areas where you would actually wind up with a different signal. And once we showed that to them, they stopped arguing because they realized that it really didn't make a difference. But a couple of more points I think are important. We found at Fortuna that the change in economic profit, or our measure of economic profit, which is cash based, residual cash earnings, is what correlates with total shareholder return more than the absolute level. And so if we're looking at, starting at, like you said before, -150 and going to 100, that's great. When we look at individual parts of the business, as long as we maintain the same allocation methodology year to year, the changes are pretty solid. The absolute might be a little higher, a little low, depending on if you use your method or my method or somebody else's method, but the changes will be very similar. And so the observation of new value creation, either when we look back or when we look at plans for the future, will be much less affected, because we're looking at the changes in performance. And just one more side note to corroborate, what you're saying, and we can get back to the next question. And this one I like a lot. A CFO once said to me, "Well, why are you allocating my cost? My cost doesn't vary. I'm a totally a fixed cost." And I looked at him and I said, "If we double the size of the business, is your salary going to go up?" Salaries for executives are driven partially by the size of the business that they manage. And if we grow the business, his salary is going to go up. So he's actually a variable cost. And, that may be a stretch in some cases because it's, a multi-tiered company and maybe the CEO is so far away from what we're trying to measure and so forth. But the point is still solid that, there are things that we think of as fixed costs that when you look at them, they really are variable.
Well, and it's is it fixed in the long run, or in the short run, etc. Right? In the long run, nothing is fixed. You can always
Yeah.
adjust things, and it's important. What I found, a lot of clients say, "Well, let me ignore fixed costs. Let me just focus on the variable costs,
Mhm.
etc." But again, it's ignoring that you can do something in the long run about those fixed costs, and you need
Yeah.
to actually know what is it right now that I need to cover to be economically profitable and to create value for my
Mhm.
shareholders.
Right, right. Or they'll price low to try to use up unutilized capacity and say, well, that's a fixed cost. And then once the capacity is full and they need to spend real capital to expand capacity, they can't go back and raise prices. And so, I agree. Fully costed is the way to go. So, to what level of detail do you go to develop these granular allocations? It sounds like you could easily go down a rabbit hole for every single line item. So, what do you
That's
recommend?
Yeah, you're absolutely right, and it ultimately it comes down to balance, right? It's focusing on either costs that are big that will move the needle, or
Hmm.
even if they aren't big, costs that are going to vary significantly across different segments. So having a sense of that, being able to look at the P&L and understand where we need to focus and where we don't need to focus, really, right?
Mm-hmm.
But beyond that, talking about level of detail, almost invariably across our projects, we put an initial data requested and we describe all that we want. And
Mm-hmm.
the first pass we get is never to the level of detail that we ask for. And clients often ask, well, why would you want this? Like, that's so much data, it's hard to process.
Mm-hmm.
But the devil is in the details, and it's by going that extra level that you end up finding little nuggets that you weren't aware of. And so some examples there, we were working with a pharmaceutical company, and their India business looked incredibly unprofitable. And after sharing this with the India team, they said, yeah, but that's because we have $20 million of costs sitting in India that aren't India related. And I said, well, wait, what is this about? And they described to me they had built up a marketing center of excellence in India that helped develop marketing materials worldwide. But
Mm-hmm.
in their legal entity structure, that unit sat in India, and their management reporting never took it out of India to
Mm-hmm.
allocate it across the rest of the world. So it's identifying that. Or another client where we worked on together, they ran a self-insurance program, and that insurance program actually was profitable for them. It was hidden in a corporate cost bucket that just showed that corporate cost being really low because it was offset by this profitability. So
Mm-hmm.
asking about that, or identifying, why is this bucket so low? Oh, well, because this other unit is in there. So we love getting all the data and being able to drill into things to identify those kinds of insights.
Yeah, that last one's a good one. I mean, and they were basically overcharging the business for insurance and then making a profit at corporate, which of course makes corporate look better because their net
Yeah,
cost, net of that profit, looks lower, and so they look like they're doing a good job. But it leads to a lack of clarity on just how profitable the business unit is because some of the profits being, sort of skimmed off the top, as it were. Um,
absolutely.
so some people think this is something that they can do themselves inside of companies, but in my experience, there's an advantage to having a third party get involved. Are you of the opinion that companies are really not able to do this, at least not for the first time themselves, very well?
I'd love to say go off and do it, but honestly, in over 20 years of working with different businesses, I have never, when I've seen what they've tried to do, I've never seen them actually get all the way there. Often they ended up excluding certain costs or not going to the level of granularity that was necessary. And I attribute that to a number of different factors. First of all, is experience and expertise. Not many people have done this, and so they don't have the experience or the knowledge of where do we need to focus, how do we go about doing this, how do we go about doing this quickly. The second problem that people have is limited resources and competing priorities. Other projects, whether an M&A opportunity or an ERP redesign, etc., the finance people that get tapped to do this kind of thing always get pulled in multiple different directions, and so they're not able to allocate significant or adequate time to get this
Hmm.
done, and the project ends up taking much longer and languishes. The third issue in many organizations comes down to internal politics,
Hmm.
where if people are trying to build this internally, they're getting pushed by different members of the team. And it's who is politically the strongest who
Yeah.
ends up winning out and pushing costs off of their P&L to
Yeah.
someone else.
Yeah.
And when that happens, you end up getting to an answer that actually isn't meaningful.
Hmm.
And if the result isn't meaningful, or the measure isn't meaningful, it's not going to get used. The fourth thing we've seen in many cases is struggling with sustainability of the measure. And basically, the pendulum swings in two different directions here. One is where the measurement is too simplistic and thus not insightful and thus never gets adopted. But the
Hmm.
pendulum can swing the other way, where the measurement is so complex that it's really tough to maintain.
Hmm.
And often companies don't have the systems because financial systems aren't designed for fully loaded granular profitability. They don't have the systems to maintain this. And so we've seen multiple organizations try to do this in Excel, where, at the end of the year, the analyst is trying to scramble and put this all together, and it ends up crumbling under its own weight. And that's kind of where we want to come in. We can do the measurement, we bring the expertise, we are unbiased in developing the methodologies, but we can connect all the information sources to deliver granular profit measurement much more frequently than on an annual basis. We can actually deliver it monthly. And if managers have access to this information on a monthly basis, they can make better decisions. They can track the results of their initiatives. They can make course corrections if necessary. They also can identify new opportunities much earlier than once a year and start making strategic changes based on those insights.
Yeah, that's huge. That's huge. If I go back to one of my experiences from my distant past, I was, as you know, I was working at Stern Stewart, the EVA company, and I remember one of the companies we worked with to implement EVA. We also, in addition to training people and giving them tools to make decisions and so forth, we changed their incentives as we tended to do. So the incentives were based on improving EVA. And then a few years later, they contacted us and said, the people don't really understand this. They're not using it enough in their decision making. Can you come in and help us figure out, what we're doing wrong? And among other things, they didn't show anybody any reports of progress during the year. It was only at the end of the year when they had to figure out the incentive that they calculated EVA and then told people what it was. And at that point, the year's over. You can't do anything about it. I think, your idea of taking this, using your system rather than an Excel spreadsheet to be able to track, granular profit on a period by period basis and provide people with the reports and the data so they can course correct and so forth throughout the year. And so they can try something and then see how it works and that sort of thing. It's just unbelievably valuable. It leads to a much more disciplined approach to execution and tactical decision making. So yeah, I think that's a really, really great. So right now, this is going to get really interesting. This is the part where we're going to sort of change the focus a little bit. So now you're expanding from granular profit measurement, as if that's not enough, into using artificial intelligence. Can you tell us more about what you're doing, to embrace AI and use it to provide even more capabilities to the companies that you work with?
Yeah, absolutely. And we are really, really excited about this. We started leveraging some AI in our original products, just helping to get data uploaded into the right places, etc. But the inspiration for this actually came from Fortuna when you introduced us to one of your long-standing clients. Um, that client in our discussion ended up saying what they really want is an AI powered tool that helps them with strategic resource allocation. If they have an extra 10 or $50 million to invest, where should they invest it?
Mm-hmm.
And we left that conversation and started to think about this and noodle on it. And we said to ourselves, this is exactly the kind of question that we would answer as consultants. We know exactly what analysis we would want to do.
Mm-hmm.
And so we started mapping things out and identified over 20 different variables we'd want to know. Because if you just had profitability as an input, what would the AI do? It would say, well, put all your incremental money here into the most profitable segment. So you need to understand things like the market size and market growth opportunity. You want to understand your capacity utilization, what requirements are for additional capacity, what your constraints are on the distribution side or marketing,
Mm-hmm.
et cetera, what competitors are doing. If a competitor just built a new plant in this product in a region, do you also want to build a plant? Well, then you're going to destroy market economics, et cetera, et cetera. So we mapped that out and we said, okay, we can actually tackle this. Now, what do we need to get this done? Let's look at what's out in the marketplace. And we looked for what kind of AI exists for financial and strategic analysis. And quite honestly, we didn't find anything.
Mm-hmm.
And so we said, there's got to be a big opportunity here. And how do we go about doing this? So far these days, when people talk about AI, largely they're thinking about the large language models like ChatGPT, right? And those models are great at words, at reading, synthesizing, summarizing text. They understand some numbers, but they're not trained in analytics, in financial, strategic, statistical analytics. And when you read about AI these days, it's all about these agentic models, how to create individual AI agents to perform very specific tasks and put them all together in a workflow to be able to get to an answer. And so we ended up designing basically our own agentic workflow where different agents perform different tasks in order to get to an end answer. We thought through what principles do we need to be able to serve this. Obviously, it needs to be a secure design, very sensitive data that's being used. You don't want to expose that to the public LLMs and have them learn from your data. You need to focus on actually delivering insights out of the information. You need the logic to be transparent in order for people to understand what the AI did, what logic it applied, and buy into it, et cetera. So we laid all those out and we began building out our capabilities here. Now, they will evolve over time. We've built the foundational capabilities, but as we put more information through it and train it on particular examples, it will become smarter. And over time, it will be able to design its own analytics based on user requests. And by the end stage, we'll be able to answer that question. I have an extra $50 million to invest. Where should I optimally put it? So it becomes like a 24/7, always available financial analyst that is already really skilled and just learns by giving them new work and new projects and becomes better over time.
That's really revolutionary. I've seen you demo this, and it's really stunning at how not just sort of smart it is, but how intuitive it is. How it's really helpful. How do you see the role of consultants? Maybe this is a little self-serving. How do you see the role of consultants with this technology in the future?
Well, AI is going to transform virtually every industry out there. I was just reading about a new product called Harvey, specifically for attorneys, that helps them, again, with that text capability, synthesize past case materials, uh, writes initial drafts of briefs for the attorneys, etc. So that industry is going to change tremendously. On the consulting side, it's going to change as well. I don't think consultants are going to go away, but the work that they do and how they do this work is going to be different. When I first joined Maricon, I remember partners telling me when they joined, they were given an HP 12C calculator to run all their calculations on before they got computers and got access to Excel. This is going to be that same step change. And what it's going to do is it's going to allow consultants to be much more efficient, to drive insights and impact much faster. It's going to completely change the economics of consulting. It's going to change the consulting pyramid where you have a partner on top and then multiple different levels of teams and then the row of analysts at the bottom. That pyramid is going to change, but in so doing they're going to be able to control costs much better and their margins actually should expand.
Mm-hmm. Yeah, it's interesting. You talked about the old days. I remember when I joined Stern Stewart in 1992, we were also given an HP calculator. I lost mine, and they wanted me to pay to replace it, and I said no, and so I never had an HP after like the first 3 months. Actually, what was interesting was we had started using computers, but we had like a little table in the middle of this big bullpen of us that had like I think 3 or 4 small computers, but you had to sign up for time. You had to like say I would like it from 10 to 11, and you would spend a lot of time thinking about everything you were going to do between 10 and 11 because you only had 1 hour on the machine, and so you went in there so prepared to. Now I think people start modeling and then they think. Back then, we spent a lot of time thinking about the most efficient way to do things before we started modeling, and
Yeah.
that was really kind of helpful. But one last thing about the old days, we used to write to the investor relations department of the company and its peers to ask for the last 5 years of annual reports so we could manually enter the data. So yeah, we've already made great strides, but I think as you suggest, the future is going to accelerate. And
Yeah.
I do agree with you that the need for consultants with certain sort of expertise that's developed when you work with many different companies will still be there. But I think many of the jobs leading up to those senior experience positions will be replaced by artificial intelligence, which just leads me to one remaining concern, which is where are the future experts going to come from if they don't have that path of doing all the grunt work, working up to becoming the expert? It's going to
Yes.
be interesting to see how that evolves.
The next 10, 20 years are going to be one thing, but then beyond that, where the new crop is going to come from, that's a big question. Yes.
Yeah, that's good. So, boy, this has been great. So we've been speaking with Dennis Kubaile of Granulytix. And Dennis, thank you for joining us for this very important conversation.
Thanks, Greg. It was a pleasure. Always enjoy speaking with you.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.